trying to sort out some of the issues regarding access. I trust the team is in the background supporting you with all of that access. So for that, really appreciate it from the team at Indonamo. Okay, cool. So let's jump into the agenda of the day as I articulated before, the 30 minutes of reading time. You would have read Piper in the background. You have all of those issues top of mind now, or refreshed in your mind. A lot of questions I'm hoping that you have in terms of, okay, how do you account for this? At the same time, a lot of big questions, a lot of answers I hope that you have in your mind in terms of how you would approach the question. But then that will come a little bit later when we go into the details regarding that. For now, let's spend the next hour max talking a little bit more about IFRS 16 end to end, and almost highlighting a few elements that are important. Now, to tell you upfront, because I know that I potentially will have the question, intention here is not to cover IFRS 16 in its entirety as if this is a CTA lecture. We just do not have enough time for that. And I don't think that's where the value of this session will be extracted from for you all. Because you have the CTA videos online on SharePoint. And if you want that level of detail to refresh yourself regarding IFRS 16, that resource is available online. In fact, it potentially is even my voice that you'll hear on those lectures, albeit a younger me. What we're going to focus on for the next hour is all those key points in IFRS 16, key elements from an exam technique perspective, things that examiners enjoy testing, things that are awareness levels, so you don't need to really worry about, and all of those sort of lovely stuff that are in between. Okay, so that is going to be the objective for this 1 hour. Of course, feel free to ask any questions. I always love interactive sessions. That's how I roll. I will probably expect to do most of the speaking in the first sort of hour, just by design, right? Because it's almost like follows a little bit of a lecture style. But please take the opportunity to warm your voices, speak to me, ask me questions, because as soon as we flip to discussing Piper, you're going to drive the session. So we're going to go as quickly as you respond with me, or slowly thereof, right? The intention is not for me to do the question, but for us to collectively do the question. Okay. First things first, what does IFRS 16 look like? So IFRS 16 is one of the newer standards, right? So what does that mean for your perspective? It means that IFRS 16 has a lot of guidance when it comes to tackling leases. And that's always, that is a benefit and a little bit of a curse. Why is it a benefit? It's a benefit because it provides a lot of clarity in terms of how to account for various scenarios from a leasing perspective, right? So it makes life a little bit easier for the preparers of financial statements, yourselves, as you aspire to be, to account for leases. Why is it why is it a little bit of a curse, or does it make your life a little bit more tricky? That is because there's a lot of guidance in IFRS 16, there's a lot of materials for your examiners to test, right? So it's then important that you're comfortable with the basic principles of IFRS 16, and I repeat, basic principles, right? Because always with these accounting standards like IFRS 16 that are quite complex, you can always sort of approach it and be overwhelmed by the level of complexities in the standards. But if you read SAICA's feedback regarding their exams, you'll find that a lot of the time the feedback is around their disappointment as to how poorly candidates fared when it came to dealing with basic principles in accounting standards. Okay, now what is a basic principle? I always say basic does not mean easy. Okay, that's a misnomer. Basic is just the fundamental principles that we need to understand from an accounting standards to assert that we are subject matter experts. I'll let you know what those basic principles are in terms of dealing with a lease. And that's all you need to be comfortable with, really, to have a successful outcome when dealing with a leasing question. All the complex stuff are almost nice to have. So try and sort of focus less on all the fluff or the technical stuff, and make sure that you're comfortable with the basic principles of accounting for a lease and why we're doing what we're doing, which is what we're going to cover in our session today. So if you look at your particular accounting standard, because it's one of the newer ones, right? 3 sections. You've got the main text, you've got the appendix, you've got the illustrative examples, right? Those are your 3 core elements of the standard you always need to be aware of. And of course, especially the illustrative examples. Because again, sometimes your examiners take inspiration from that. Of course, it's always important to understand sort of the objective of a particular accounting standard. So again, I'm not going to work through that, but just make sure that you're comfortable with the objective of IFRS 16, and also some scoping exclusions that are relevant with regards to intangibles and sort of licenses that are dealt with in IFRS 15. I'm not going to run through all the definitions on this slide, but we'll come across sort of all the definitions sort of as we go along. Okay, and as we go through definitions, I'll let you know the pieces that examiners like testing. Okay, so identifying a lease. So again, so before we go into that again, just one more thing to mention. Another reason why IFRS 16 is just always quite popular with these exams is because it's quite a newer standard, right? So barring, again, now it's IFRS 18 and 19, which are the newest standards, but they're not effective yet, so you wouldn't need to worry about them. IFRS 17, insurance, not part of your syllabus. So besides all those 3 new standards, IFRS 16 is the newest, right? So quite popular, topical, examiners like testing it. So make sure you're comfortable with this accounting standard, right? And that's exactly why it's one of the few standards or few areas we're discussing in this program, right? So we're not doing that just because it's for fun. Identifying the lease, a lease is a core skill, right? So you need to be able, and it's one of the rather updated or call it new areas in IFRS 16. The assessment is the same from the lessor and the lessee perspective. So again, with IFRS 16, it's important, and I know I keep saying again, I think it's just a habit, not that I've said something, but just forgive me. So with IFRS 16, it's important to understand which side of the coin you are sitting on, right? Same thing with IFRS 9. So all these contractual standards, it's important to know whether or not in the context of a lease, you are the lessor or the lessee. Or while you're assessing whether a contract contains a lease, you are a customer or a supplier. Why is that important? It's important because if you get the perspective wrong, you're dead from the beginning, right? So it's an important analysis, and it may sound simple to you, but you'll be surprised at how often it gets forgotten, particularly in IFRS 16, because the accounting from the lessor's perspective, right, is very different to the accounting from the lessee's perspective, right? So the lessee is a party sort of receiving the asset to be used, and the lessor is the one providing the asset to be used, right? So lessor supplier, lessee customer. And again, it's one of those things where you probably think to yourself like, I mean, obviously you have to think about that, right? But you'll be very surprised as to how many people get that wrong, and then it's dead from the beginning. And in particular, the area, and I'll mention it again when we get to lessor accounting, is because when leases pop up, they typically pop up from the lessee's perspective, right? So you probably have a lot of you have a lot of questions in your question bank. You probably do a lot of past papers, and you probably come across a lot of leasing questions. And probably 9 times or even 8 times, 8 to 9 times out of 10, it's going to be from the lessee's perspective, right? So you're going to get into a little bit of a habit, right, of not thinking about this particular point. And then the one time it comes to you from the lessor's perspective, the wheels fall off because you do lessee accounting and you walk away with nothing, right? Same thing with financial instruments, right? Like a convertible instrument, for example, right? Where from the issuer's perspective, you have to split this instrument into its component parts and classify each piece. But from the holder's perspective, you don't need to do that, right? The whole thing is just a fair value through profit and loss financial asset, right? But then we will find a lot of candidates still splitting the instrument into its pieces. Why? Because they're not pausing to think about, okay, who am I? Lessor, lessee, right? So spoiler alert, let's see what happens when we walk through Piper, right? When I ask you, what are you thinking when after we've just read this sentence, right? Let's see if that's gonna be the first thing, one of the first things any one of you point out to say, I want to be comfortable here in terms of who who's who in this contract, who's the lessor, who's the lessee, because this is the impact that it will have, right? Critical thinking, critical reading as you read. Okay, so that's just super important. Definition of a lease will come at you as a discussion question typically, right? So discuss whether or not this contract is a lease. Now, one thing that's important to note, to remember, is a contract isn't a lease just because I call it a lease. And a contract is not a lease just because I do not call it a lease, right? When you are critically reading a scenario, you need to make sure that you may read a scenario and it may come to you and say, X party entered into a lease with Y party. In that scenario, it's reasonable to presume that your contract is a lease. But from a critical reading perspective, it's always important to keep your mind open to the question of what, or i.e., is this thing a lease? In other words, am I going to read anything as I continue going on that's going to either further confirm or take away from my assumption that this contract is a lease? Or you could read about a contract, a supply agreement, and that makes no reference to a leasing contract. Again, the onus is now on you to now, in your critical thinking, to say, hang on, this contract resembles a lease. Therefore, is this contract actually a lease and not maybe a revenue contract as the scenario purports to account for this particular contract? Why is this critical reading important? Is because as soon as then you get to the required, and then you realize the question says discuss whether or not contract X contains a lease, you've already done all of that thinking during reading time. That's the key, and we're going to practice a little bit of that in sort of when we discuss the Piper shortly, right? I always preach this. You need to do your thinking during reading time, and then during writing time, you just execute it. Why? Because there's no time to think and fluff around during writing time. You do as much of your thinking during the reading time as you can, right? So active reading, critical reading is crucially important. So definition of a lease needs to be top of mind, needs to be engraved in your mind such that you can read through a fact pattern and can pick up on these elements of the definition of a lease as you read through without being prompted. Okay, this is definitely a basic fundamental skill, without a doubt. What are these key elements of the definition of a lease? So contract, you have to have a contract, right? So I mentioned earlier, these contractual based standards. So with a lease, you need to have a contract. Typically, the contract element of it isn't the area where examiners sort of like to dive into, but you never know, right? Contract is essentially an enforceable sort of contract, and it can be written, it can be verbal, it can even be implied. But I don't believe examiners would go to the extent of making it sort of an implied contract at this level. Right, that conveys the right to control the use, right? So the right to control the use is specifically defined, right, as these two things, right? So an entity has a right, the customer, has a right to control the use if that customer has a right to substantially all of the economic benefits of the identified asset and the right to direct the use of the identified asset. So those two elements are also defined. Then we've got identified assets. So what is an identified asset? And substitution rights come into play there, which is extremely important, over a period of time in exchange for consideration. So from an exam technique perspective, what's on the page here? There are all your marks, right? The plan, right? So we're going to talk about the plan when we read through the required of Piper. Piper doesn't necessarily have a question that asks you to assess whether or not a contract contains a lease. But if it did, what is the plan for me to maximize my marks? It is what's sitting on the page here, right? If I'm asked to discuss the definition of a lease, I need to discuss that there's a contract. I need to discuss the right to control the use, which is comprised of these two elements. I need to discuss whether there's an identified asset, period of time, exchange for consideration. So at a minimum, I can expect 1, 2, 3, 4, 5, 6, 7. 7 marks for such a discussion, right? Potentially more, because there may be more sort of nuances that examiner wants to test that they want you to discuss. But the point is, if you have this on your page and your plan, you know all the pieces you need to discuss. And crucially, from an exam technique perspective, you know that these two elements at the end here, period of time, exchange for consideration, are probably the two, and contract, are the three easiest things to discuss, three easiest marks to get. That's 3 marks out of 7 at a minimum And you can already see how when you just plan, right? So you come in with a plan, you can actually, from an exam technique perspective, purely get some good outcomes. And then you can deal with all the complex stuff with that momentum. Now, obviously, if you're assessing whether a contract contains a lease, a lot of sort of pervasive type acumens come into play, right? Particularly critical thinking can come into play here. And some of those business acumen sort of competencies can come into play where you're assessing that substantial, who has the right to substantially all of the economic benefits and who has the right to direct the use of a particular asset. Okay, so the decision tree becomes quite useful. I'm not going to work through this decision tree. It is in your standard, right? So it's another quick and easy way to ensure that you are touching on the right pieces on your discussion, and then following down the decision tree in terms of who has the right to direct the how and for what purpose. Sorry, the use throughout the period of the contract, whether it's a customer, supplier, or no one. Going into some of the specifics, right? From an identified asset perspective, there's two key principles that that can be assessed. Whether or not the asset is explicit or implicitly implied in the contract, right? So explicitly, it's quite easier to pick up. The implicit ones are a bit trickier, right? So that's where your critical thinking, critical reading needs to come into play. How can you make it easier to identify implied assets in a lease, right? Think about contracts that can only be fulfilled with a specific asset, right? So if you're reading about a contract to provide some sort of service, however, as part of that contract, it becomes quite clear, or it's implied that we need a specific asset to fulfill this contract. Then that should almost try to trigger your mind to say, okay, hang on, is there an identified asset here in this contract? And then do I need to be thinking about the lease definition? And then, of course, substitution rights, right? Substitution rights is probably the core concept when it comes to identified assets. So whether or not the supplier has substitution rights. Now, that substitution right also comprises of two elements to discuss, right? The practical ability and whether or not the supplier has economic benefit from substituting. So you'll find that one point in the core definition, identified assets, can be split into two sub-principles, right? Implied explicit and the substitution rights. Now, again, just mentioning that the asset is explicitly identified in the contract or the asset is implied in the contract, typically that counts with a mark, right? So such a simple thing to mention, to pick up, and a lot of people don't mention these things because they think it's obvious. But as an examiner, I don't know that you know unless you tell me that you know. So again, the basic principles, like I mentioned, that really, for the most part, are the ones that change, that move the needle. Okay, so I'm going to skip over that in terms of practical ability, sort of substitution rights. But what I say, it sort of stands regarding sort of how key this assessment is. It can be a simple assessment. It can be a more complex assessment. The standard gives some indicators here to help you sort of make that analysis. Okay, so I'm not going to go into that. Again, if you just joined, if you're wondering, objective of the session is to give you those sort of nuggets in terms of what to be thinking about when thinking about IFRS 16. If you want the full lecture, that is available on SharePoint. Okay, and you can sort of deal with that in your own time. Capacity portions. Now, when it comes to leases, this I haven't seen often. Potentially it's because of the judgment that's involved when it comes to dealing with capacity portions. But we're going to see an element of this, not exactly in the leasing context, but in the investment property context when you look at Piper. But ultimately, you can have an asset that's used for multiple things. So then the question is, do I then have to separate the asset into like little pieces and classify each piece? Or do I have an asset that has a blended use, right? So the typical example that's used is, think of a mall, right? So you can have a floor space in a mall. And then while you're walking in the aisles, you can have that little cart in the middle, like where they sell like perfumes, or they try to give you massages or whatever they do there in the middle of the mall, right? The question therefore arises is that space that cart occupies, when we assess the definition of a lease, do we assess that specific area that the cart is occupying, or are we unable to identify a specific space? Therefore, we need to assess the whole mall as an example, whether or not that whole mall meets the definition of a lease. Long story short, in that scenario, we would assess just that floor space that's been taken up by that particular cart, and then contrast that to a fiber optic cable, right? So I'm sure most of you are on Wi-Fi, as chances are your Wi-Fi is being driven by fiber, right? And that fiber cable usually is used by multiple parties. Now, in those scenarios, it can be very difficult, not even possible, to determine who's using what part of the cable, right? Or another example is a water pipe, right? So let's say we have a huge water pipe. So Joburg Water has a huge water pipe, and let's say 3 parties are using that water pipe or leasing that water pipe to transport their water from point A to point B, right? You can't say party A, party B, party C is occupying this portion of the pipe, right? It's just one pipe. So in those scenarios, you don't have a physically distinct portion of the pipe. Therefore, we need to assess the pipe as the entire pipe for the definition of a lease. Okay, but like I mentioned, I haven't sort of typically seen this in an exam, but not to say it won't pop up, right? As you can see, it's a core competency, and then there is an illustrative example in the book that can assist you with this particular concept. And I think in the illustrative examples, they talk about a gas pipe, but yeah, principle is the same. Okay, then the right to direct the use, like I said, is split into 2 parts. The right to substantially all the economic benefits, and the right to direct the how and for what purpose the asset is used. Now, the easy marks here, or the easy thing to discuss, is the economic benefits in the one, right? If I go all the way back here. So this second part, paragraph B9, speaks to how you assess the right to control the use. So who has the right to control the use of the asset? Then B9 says, okay, when assessing who has the right to control, consider who has the right to substantiate all the economic benefits and who has the right to direct the use of the identified asset. Now, the easiest one to discuss is bullet point number 1, okay? Because that you just need to look at the output of the asset, right? And then who's getting all the benefit from that output. So the output of an asset can be anything, right? With the example that I used with the water pipe, it's transporting water. The example I used with renting the floor space, it's the benefit from that space. If it's a car or motor vehicle, it's the benefit from using that motor vehicle. So who has the right to substantiate all of that benefit? Okay, so that's an easy thing to discuss, because it's going to be quite clear in your scenario who has the right to all of that, and the judgment levels will not be that high at this level. So easy one to discuss. And then when assessing who has the right to direct the use of the asset, then that becomes a little bit more tricky. Just flip all the way back here, because there you have to talk about the how and for what purpose, right? So who has the right to direct the how and for what purpose the asset is used? And to do that, you have all of these questions that you can ask. Who has the right to discuss what we do with the asset, when we use the asset, where we use the asset, and whether we use the asset, right? So if you think about all of those sort of 3 areas, not all of them will always be applicable, right? Sometimes there will only be 2 decisions that are relevant, sometimes 3, sometimes only 1, depending on the asset and how it is used. So don't stress about trying to apply all of them, but ultimately, as many as seems sort of relevant. And then if it is the customer that directs all of these types of decisions, then you can conclude it's the customer that directs the use. If it's a supplier, you can conclude it's a supplier. If it's inconclusive, if nobody actually directs the use, then you sort of consider 2 more questions regarding who operates the asset or who designed the asset, right? So it's a little bit of a webby decision tree, but it's all sort of covered in this particular decision tree to let you know sort of how all those decisions sort of interact with one another, in terms of how this decision tree flows. Hold on. Let's see if there's anything more to discuss. I think I'm pretty much done, so I can run this off. Okay, yeah, can run this all. Okay. So, in conclusion, definition of a lease, right? Your plan, your guideline is the definition itself that I shared on this particular page. And or the key things to discuss is what I've highlighted on this page. A couple of things are more complex concepts that we need to discuss things even further. For example, um, contract, period of time, exchange for consideration. Those are simple concepts that we can discuss upfront and earn those marks from an exam technique perspective. Then once you've discussed all of these three elements, then you can dive into these two, right, to control the use and identified asset, because those are far more complex elements in the definition that you need to sort of go a layer further to discuss things even further. Specifically identified asset, what you need to be thinking about: substitution rights and the asset, whether the asset is implied or explicit in the contract. Right to control the use is quite a complex concept, so I would recommend you sort of think about this one last, just from an exam technique perspective, just to get your momentum going, right? So discuss this once you've scored all the other marks. And then when you discuss right to control the use, you need to discuss two things, so a layer down. Who has the right to substantially all economic benefits? If that, and that's, like I mentioned, the easier mark to get. And then the second bullet is far trickier, right? Who has the right to direct the use of the identified asset? That's when you discuss who has the right to direct the how and for what purpose the asset is used. Okay. And then at that layer, that's when you need to discuss all of those elements that we mentioned earlier on. Decision tree is extremely important, or helpful rather, to help you navigate all of that analysis and score all of those marks. Always remember to conclude, right? When it comes to discussion questions, and another feedback point that Saika always mentions, everyone is always way too focused on trying to get the right answer, as opposed to being focused on your journey to your answer. So I always distinguish it in two ways. Worry not about having the correct conclusion. Your only worry should be concluding correctly. Okay. That may sound like the same thing, but it's subtly different. Coming to the correct conclusion, to the right answer, is less important. What's important is your journey towards reaching a conclusion. So your journey through this decision tree, as an example, and then ensuring that whatever you conclude is aligned to what you have analyzed in your analysis. Therefore, you have concluded correctly, aligned to what you have discussed, and therefore that conclusion mark is going to be yours, right? Because it is almost consequential to what you've discussed. But now, if you try and hedge and try sort of change your conclusion last minute, just because you think the answer should be lease, then you are in a lot of trouble from the beginning. Okay, so try focus on the discussion as opposed to focusing on the journey there. Okay, so again, examples in your book that I'm not going to go through because we just don't have the time. Okay, any questions while I flip through the next key point for us to talk about? Cool. Either it's a thumbs up. Okay, maybe let me ask another question. Are we still all together? Because yeah, we're very quiet and I haven't gotten any questions. Cool, I see thumbs ups. Awesome. Perfect. And I hope you're keeping notes, because all of these little yeah, this is if I can say so myself, quite important that we sort of taking all of this in. Okay, let's talk about accounting for leases. So now we've talked about discussing whether a contract contains a lease. And for that assessment, I said, from if you're coming from the lessor's perspective, lessee's perspective, the assessment is the same, right? So you don't need to worry about perspective. You worry about the contract, because what is the question? The question is, does this contract contain a lease? So now you're assessing a contract. Once you've concluded that your contract contains a lease and you have your lovely conclusion mark, then we now talk about lease accounting, right? So you'll notice when you read your standards, when we're assessing whether a contract contains a lease, it says customer supplier, right? Because at that point, we don't know whether or not our contract is a lease. But when you read your accounting standard regarding the sections that deal with accounting for leases, you'll see that the terminology changes to lessor, lessee, right? Acknowledging that now we're in the lease accounting world. Now, once we are in the lease accounting world, now the lessor accounting and lessee accounting becomes different. So again, it's important to understand your perspective. Who are we in this contract, and who has the required asked us to consider, right? From whose perspective? Now let's start with lessee accounting, the more popular one, right? It only makes sense to start here. Now with lessee accounting, sorry, the important thing to realize is that there's one model to account for a contract from the lessee's perspective, right? This is something that obviously caused a lot of confusion previously when the standard was newly issued, because some people learned the previous accounting standard where it was a little bit different. So either you have that history or background, or you're just learning this for the first time. So either way, it's important to be aware that we now have different models for lessee accounting, whether you're the lessor or the lessee, which means from an exam perspective, exam technique perspective, I repeat, it's important for you to know who you are in the contract. And I keep repeating this because that could be the difference between you walking away with almost 30 marks in a question and nothing in a question, because the accounting is so different. Okay, so it's important that you please consider this carefully when you're responding. Lessee accounting has one model for accounting. For a lessee, the party that receives the right to use the asset and at the same time incurs an obligation to make the lease payments, they have to recognize a right of use asset, so like a PPE item, at the same time recognize what is usually an equal and opposite lease liability on their statement of financial position, with a few exceptions. There are two. Short-term lease, low value asset. These are recognition exemptions, right? What is recognition? Recognition is bringing something onto your financial statements. Okay, now it is very important to understand these terminologies as well, which I'm hoping that we're all comfortable with, because understanding this terminology is important for understanding required for accounting. If you don't understand, let me put it on the page here. If you don't understand, okay, this is not the greatest standard to show this, unfortunately, but it's fine. I'll just leave it here. If you don't understand what definitions are and what sits in the definition section of a standard and scoping requirements, okay, albeit I'll admit, right, maybe a little bit less important at an IAC stage and more important at an APC stage, but still important nonetheless. Definitions and scope, right? Which standard do I need to be thinking about? Then recognition principle. What does recognition mean? It means bringing something onto my financial statements. How can you think about this practically? It means passing a journal, right? If I meet the recognition criteria, I need to pass a journal entry to recognize something, to bring something onto my financial statements. And then what number do I put in my journal entry, right? How much? That's a measurement principle. How much on the day one, initial measurement? How much going forward, subsequent measurement? When do I take this thing off of my financial statements? De-recognition. How do I show this thing in the statements of the income statement, statement of other comprehensive income, statement of financial position, statement of cash flows, and the statement of changes in equity? Presentation. What do I put into my notes to describe these transactions? Disclosure. It's important to understand these key headings in an accounting standard, which you can see quite nicely here with lessee accounting going all the way down to disclosure. Why is this important? It's important because your questions in IAC could ask you to discuss the initial measurement of a lease. Now, if your examiner asks that question, they are only looking for you to ask to discuss a specific part of the principles regarding, let's see, accounting. Only those that deal with initial measurement. So if you go and discuss things that deal with subsequent measurement, you are wasting your time. Okay, so it's important to understand what sits in what section of the accounting standard. So which principles sit where, right? So if we talk about depreciation, that's subsequent measurement. If we're talking about capitalizing import costs that are not refundable, that's initial measurement, right? What principle sits where? So when it comes to lessee accounting, there's one model which involves recognizing a right of use asset and lease liabilities, unless these two exceptions apply. Now, these two exceptions, recognition exceptions, are where you have a short-term lease, where you have a low-value asset. These are by election. So in your exam, you have to be told that the preparer has decided to use these particular two elections. But at the same time, always just be aware of the opportunity to apply these elections, right? How can you pick up those opportunities? For the first one, is a lease that's less than 12 months. That's a little bit obvious. The latter one, they'll give you an accounting policy in terms of what the entity considers to be low value, right? It'll be probably like at the end of the question. Then as soon as you read that, then you say, okay, cool. Which asset here could be a low value asset? Because from a critical reading perspective, we're going to practice these skills, asking yourself, okay, why is the examiner telling me this information? Is a useful critical thinking question that you can ask yourself as you read through information to try and unpack what it is that you're reading. So I'm not going to go through the two recognition exceptions, right? Again, the detailed notes and videos are. Oh, sorry, somebody muted me, so I'm guessing either you're tired of hearing my voice or it was a little bit of a mistake. I'll assume it is the latter. Oh, or rather, not assume, I'll hope it's the latter. Okay, so I'm not going to jump into details of what these two exceptions are. But key is to always be aware that these exceptions are there, right? So for the short-term lease, the only clue that you can really get is a really short-term lease. And then for the low value asset, a clue that you can think about is if they give you an accounting policy of what is a low value asset, because that particular sort of guidance is not in the standard. So entities have to have their own accounting policy choices, which you will have to be told in an exam scenario. Okay, I've got a question there in the chat. So what if the lease doesn't elect to apply the two exceptions? Do we use the model applicable to long-term lease? Absolutely, Nokutula. That is the thinking. So if the entity does not elect to apply these, the lessee does not, and I like that you say specifically, right? Lessee, right? So that's awesome stuff. Yes, then we apply the long-term lease accounting. Okay. Cool. So we're going to okay, and this is maybe just a little bit of a nuance that maybe your examiner may look to test, right? So for short-term leases, these need to be made by class of underlying assets. So for example, so all of my cell phone leases are short-term leases type of thing, right? So you can't pick and choose which lease contracts to apply the exception. Whereas for low value, you can choose on a lease by lease basis. So maybe if you're asked to review something, that particular issue may come up. Okay, I'm not going to go through sort of the accounting for short-term or low value leases. It's ultimately sort of operating lease type accounting, right? So recognize your lease expense on a straight line basis over the lease term. Okay. Now, when it comes to lessee account, go for it, Felicity.
Good morning, I'm sorry, can you go back to the, and morning everyone, sorry, can you go back to the slide. So you're saying that, just want to understand if they need to tell you if it's either a short-term lease or a low value asset, or I'll need to apply maybe the criteria in terms of the short-term lease to say it's below 12 months, or the scenario will specifically say this is the entity elected to apply the to the short-term lease?
Yeah, great question. And as an examiner, we have a little bit of a dilemma, right? Because on one hand, we don't want to give away the answer, but on the second hand, because of this sentence here, right? A lessee may elect to apply the requirements. Um, a lessee has to formally make that election to apply these requirements. And if they don't, then the basic rules of lessee accounting are applicable. So as examiner, I've got a little bit of a problem because I don't want to tell you as a candidate that these exceptions are applicable. But at the same time, I need to tell you that they're applicable. So how can I go about resolving my dilemma? One, I could ask you a review question. So I could say, this is what we've done, right? And we've elected to apply the short-term lease exception to, let's say, a 24-month lease, right? Then I could then say, critically review the journals or critically review my accounting memo or what I intend to do. And then in your response, you can say, okay, but hang on. We can only make this election for a short-term lease if the lease term is less than 12 months. Your lease here is 24 months. That is inappropriate. Okay, so that's option number one. Option number two, what I can do is I can give you a fact pattern that has a lease that is short term, so less than 12 months. And then somewhere in the scenario or in the additional information, I could say the lessee, the entity, chooses to elect any accounting options that results in easier or simpler accounting or more straightforward accounting or something along those lines, right? Just almost a hint that if there's an option for simpler accounting, the entity will take it. Then you now have to connect those two pieces to say, okay, fine. I see here that we take any elections or practical expedients that are available. I see here that there is one available here. Put two and two together. I need to account for this thing as a short-term lease or a low-value asset lease where that is the case. And then the last option, at least in my view, would be just to tell you that for this lease, we apply short-term lease and that assessment is appropriate. So then you can just go ahead and account for it as a short-term lease or a low-value asset lease. So I hope that sort of answers your question in terms of what you can expect in an exam.
Yes, thank you so much.
Cool, awesome. I've got a couple more questions here in the chat. So Blessing says, for practical purposes, do we just rely on entity accounting policy to determine what's a low value? For comparability, is there a range that can be used in the same industry? Okay, yeah, great question, Blessing. And that's a lot. You bring in some critical thinking, you bring in some business acumen. It's some lovely thinking. And the type of thinking that could potentially be relevant or worth those sort of acumen marks in a discussion question. So worth highlighting to everyone those particular points. But to answer your question more directly from an accounting perspective, either two things. One approach is you will get the accounting policy because they have to tell you, or the number that sits in the BCs of the accounting standard. Now, BCs are bases of conclusions, which are not part of the standard, right? So that's why it's not a rule. But typically, you can think about $5,000, which if you convert this exchange rate, I'll just use 20 for simplicity, that would be 100,000 rands. Seems like quite a big number. But that would be 100,000 rands. Cool. Thank you, Nokutula. That's exactly the number, but in dollars. I have a great question, Charlene. So Charlene asked, okay, but what happens? How do we overlay substance into all of this? So at which point do we bring in substance? So say it's a 12-month lease, but the information is of a long-term lease. How do we then classify it? Great question. Because then what is a short-term lease? Or what is term? Term comes back to the definition of lease term. And that's where your substance comes into play. Because when you're assessing whether or not a lease is actually 12 months, we don't just say, okay, look at the lease contract and it says 12 months, therefore or it says 11 months, therefore that's easy assessment, boom, I'm in the exception. No, you need to apply the definition of a lease term, which is, I think, I would have said it's a nice segue, but I think it's a little bit premature to discuss it now. But It's less than 12 months according to the definition of a lease term in IFRS 16, which tries to capture the substance that Charlene is referring to in the chat. So what do I need to be thinking about when thinking about substance? I need to be thinking about renewal rights. Sorry, there we go. Someone is on unmute. Okay. Please just wiggle your mouses, check your screens, just check that you're on all of mute. I can't see who it is, but I can hear something in the background. Okay. So it needs to be the definition of a lease term per IFRS 16, which considers substance and thinks about renewal rights, cancellation options, and whether or not it's likely that those are going to be exercised. So for example, if I entered into a contract that is for an asset that is critical to my business, right? I need this asset, and it's quite a specialized asset. But I do not want to deal with all this lessee accounting. So I structure this contract such a way that I say it has an 11-month cancelable period. However, it can be renewed on every year on an annual basis for another 15 years, right? If you just think about that particular lease, yeah, the non-cancelable period is 11 months, but the likelihood of me not extending this lease for this asset that's specialized and crucial to my business is extremely low. So definition of a lease would then require me, lease term, sorry, to consider those renewal options in my lease term. So let's say renewal options up until year 10. Therefore, you can see that my lease term, according to the definition of a lease term, is 10 years. Therefore, I'm going to fail that the less than 12 months requirement. So absolutely, substance comes over legal form. Good question, Sean. And again, that critical thinking, those acumens coming through in this analysis, right? Because how do these acumens come through? I'm going to discuss it a little bit more sort of shortly because it's a little bit premature to discuss lease term now in our discussion, but we will definitely get there. Cool. Actually, we'll probably get there like right now. So probably a good time. Right. So how do we account for what everyone seems to be calling in the chat a long-term lease? Or like a normal lease, right, from the lessee's perspective, where the recognition exemptions do not apply. It's a relatively simple concept, really. It's you recognize a lease liability, which is ultimately just the present value of your lease payments. And then on the other side is an equal and opposite right of use asset. Okay, simple enough principle. But then how do I like to think about this to remind me of all the key things I need to be thinking about? Is literally your NPV, your NPV calculation, right? So how do I get a present value for the lease liability? PV, I need N. N is a term, so I need a lease term. PMT and FV. PMT are my payments. FV is my future value. Those two elements are my lease payments. Sorry, those are my cash flows. My interest rate is either the interest rate implied in the lease or the incremental borrowing rate. Now, I'm going to pause here because it's something that I didn't mention before we jump into the principles. This is core, fundamental, what's sitting on this slide. So let's ensure that we're comfortable with these principles because this is going to be the crux of lessee accounting. Okay. And like I said, I like to use my PV calculation as my roadmap, my plan in terms of what I'm going to discuss, what I'm looking for in a scenario when dealing with lessee accounting. I'm always thinking, okay, my PV calculation. I know what am I looking for with my PV calculation? I'm looking for my lease payments, which is my PMT, my payments, my annual payments or monthly payments or whatever, and my FV, right? My value, my payment at the end, right? My guaranteed residual. Then I'm thinking about a lease term, N. Then I'm thinking about I, my interest rate. Okay. So let's start with PMT, payments, and FV, the future value. So those are the cash flows. So my lease payments. And I only include numbers that meet the definition of a lease payment. A lease payment is defined in the standard. So what does this comprise of? Fixed payments, which you're all comfortable with, right? And also includes in-substance fixed payments. Now, in-substance fixed payments, I haven't seen tested often. I think just once. And it's just that scenario where you've got lease payments that seem variable but are in substance fixed. Now, the reason why it's challenging to examine this is because of the judgment that's involved when it comes to analyzing, assessing whether or not a payment that looks variable on paper and legal form is in substance fixed. So if you ever encounter these, it's likely that your examiner will make it quite clearer that the payment is in substance fixed. Okay, less any lease incentives receivable, right? So you'll be told about any lease incentives that the lessor has given the lessee to entice them to enter into this contract. Variable lease payments, an examiner's favorite. I'm literally pausing for emphasis. An examiner's favorite. Okay, so the only variable lease payments that come into your calculation are those that are based on an index or a rate, or market rate rather. So think inflation, right? So it's like something that's market related, right? So it impacts everyone equally. The variable lease payments that are excluded from your lease payments are those that are entity specific, right? So not market related. So like something like a lease payment that's linked to revenue, a lease payment that's linked to usage, right? Those are expensed when incurred separately. An examiner's favorite. Okay. Residual value guarantees, right? That's my future value. So only the guaranteed residual value. Unguaranteed residual value is not a lease payment. It's not a cash flow, right? Therefore, it's outside of my lease liability measurement. Examiners love playing around with these unguaranteed, guaranteed residuals. If ever in doubt, just open your book and check. It'll be it's there. It'll be in your book. Okay, whether you use guaranteed, unguaranteed, or both. Purchase options, haven't seen these often, right? But if it pops up, right, if there's a purchase option, then the cash flow we have to pay, I'll come to you just now, Happiness. The cash flow you have to pay to exercise the purchase option needs to be as part of your lease payment. It makes sense. And if I'm in a lease and I expect to purchase the asset after 5 years, then I should include that purchase price in my NPV calculations. And any penalties for terminating a lease if I'm reasonably certain to terminate the lease, right? So if I'm in a 10-year lease, but I'm reasonably certain to terminate this thing after 5 years, therefore my lease term is 5 years. Therefore, whatever I'm going to pay when I terminate this lease in 5 years, I need to include as part of my lease payments, right? So if there's a relationship between your assessment of lease term and your cash flows. Happiness, jump in. Feel free to jump in with your question. You're on mute. Okay, I'm gonna push on. Okay, cool. I see you've come off mute. Jump in.
Um, sorry to take you back and that is it a very guaranteed because I'm always confused in a question you are given the guaranteed residual.
Sorry, Happiness. I'm struggling to hear you. Your voice sounds a bit muffled.
Okay, I'll get back. I'll come back. Let me maybe it's my headphones. Let me try
Okay,
to
cool.
disconnect.
Okay,
I'll
cool.
come
Yeah,
back.
thanks for that. Yeah, cool. Thank you. Sinalo?
Hello.
Hi.
Can you please go through variable lease payments again?
Yeah, sure. Yeah, is that
Thank
important? Happy to.
thank you.
So, with variable lease payments, right? What's your challenge? Your challenge is trying to identify okay, your challenge number one actually is identifying a variable lease payment. So how do you identify a variable lease payment? The easiest way to pick it up is on day one. Is there a portion of my lease payments that actually I don't know what I'm going to be paying in the future, right? Or do I know exactly on day one how much I'll pay in the future? Right? If you're in the latter, I know exactly how much I'm going to pay throughout this term of the contract. You're in the fixed lease payment world. If on day one you don't know how much you're going to pay, you're in the variable lease world. Now, your lease can be variable based on two main factors. It can vary due to a market rate or a market index, or it can vary due to an entity specific factor. So varying due to a market rate of interest is something that impacts anyone the same. So the most common one that your examiners love is inflation, because inflation is essentially an index. So you can enter into a contract that says your lease payments are 1,000 rands adjusted for inflation every year to increase the number by inflation every year. Okay. So on day one, I don't know what inflation is going to be next year. Therefore, I don't know what my lease payment is going to be next year. Okay. So I've got a variable lease payment. Step two, is my lease payment variable because of a market factor or entity specific? Inflation impacts everyone the same, equally, right? Therefore, that's a market specific impact. Therefore, my variable lease payment depends on an index or a rate. Therefore, I need to include that 1,000 rands into my PMT in my calculation when I calculate my lease liability. But then you can say, but hang on, my lease is for 5 years, but I don't know what inflation is going to be over the year. So what do I put as my PMT? You put the payment now, as of today, right? Based on today's number. And then we'll talk about what happens in future when inflation does change your lease payment. But because that's subsequent measurement, right? Because now we're talking about initial measurement. Okay, but then what if my variable lease payment depends on an entity specific factor? So let's say my lease payment depends on how many widgets I produce using the machine, or how much electricity I generate, or how much revenue I generate from the store, right? That also varies because I don't know how much I'm going to sell, produce, manufacture in the future, right? But it's varying because of an entity specific factor. So how much I produce, how much I generate, how much I sell as an entity. Therefore, I don't include that lease payment as part of my lease liability, but instead I expense that when I incur it. So after year one, I produced X amount of electricity. I incurred 5,000 rands because I did that. Therefore, I debit expense 5,000, credit payable or bank 5,000. So I'm accounting for it separately from my lease because it is a variable lease payment that does not depend on an index or a rate. I hope that answers your question.
Yes, it does. Thank you so much.
Awesome. I think Saki, I see a hand.
Good morning, sir. I just wanted to ask, you see, regarding this slide, when you make present value, the calculation,
Yeah.
when you put a PV. So here I always struggle because, okay, I know that there's fixed payments, right? That we're gonna put, but I always struggle with the guarantees, guaranteed or unguaranteed. Is it a plus sign in the PV? Is it a minus sign? Does it depend? And then just generally, what? Because I only thought, okay, fixed payments, but then now when I see the memos come back, I see that, I struggle a lot with PV.
Okay,
Thanks.
cool. No, I don't want was. Let's just do it here quickly. Just give me a second. How am I going to do this? Excel. Cool. So PV calculation, right? So PV is what you need to think of in terms of your plan, whether it's a discussion question or it is a calculation question. I always use the PV as the basis of my thinking. So we spoke about PMT. We spoke about I. No, I haven't spoken about I yet. We haven't spoken about N yet in detail, and the future value, which is a V. Present value these four elements, and you'll get your PV number, right? So right now we're talking about these two. So your cash flows, right? So PMT and future value are your cash flows. Now, to answer your first question, your signage. How do you spell signage? I hope that's how you spell signage. Right? Doesn't really matter. You just need to understand two key things. One, you decide, right? That's the first thing. Two, consistency. So, what do I mean by you decide? Okay, you need to decide whether or not you're going to show cash outflows for the lessee as a negative number or a positive number. Once you make that decision, right? So let's say you say I'm gonna show my cash outflows as negative. So a lease payment will be a cash outflow, negative, and then your guaranteed residual will also be a payment, right? So it's going to be a negative cash flow, right? So you're consistent, right? And then when you do your calculation, your PV number will also be negative, right? Because it's a liability. Okay. Well, because you put negative cash flows rather, right? However, you could say, okay, no, I don't mind. I'll just work with positive numbers. So my cash outflows will be positive. Therefore, you just need to make sure that all your cash outflows in your calculations are all positive. Therefore, when you do a PV calculation, you're going to get a positive number. And a positive number is your liability. Okay. So two things. You decide whether you want to do cash outflows or inflows negative or positively. Second thing, consistency. Just make sure that once you decided, all your inflows are the same sign, and all your outflows are the same sign. Okay, so that's to answer your one question. The second question around guaranteed or unguaranteed. So I'll put here residuals, right? The answer to this is it's in your book, right? So whenever in doubt, right? What did you ask me now? You say, okay, fine. I don't know whether or not I need to include the guaranteed residual, unguaranteed, or both when I'm calculating my lease liability, right? If you go into your book, right, and I'll even show you from the book. Where it talks about the initial measurement of a lease liability. And then it talks about that it's the present value. This is up here, present value, etc. Blah blah blah. Then it says these are lease payments as defined, right? So your cash flows. And then here on paragraph C, amounts expected to be payable by the lessee under a residual value guarantee. Okay, it tells you just the guaranteed residual. You're not going to see here unguaranteed residual anywhere in this list, right? Therefore, that tells you when you're calculating your PV, only the guaranteed residual needs to come here. Okay, you ignore the unguaranteed. The unguaranteed only comes in when you're trying to infer an interest rate, which we'll talk about shortly. And that, again, is in your book, and I can show you where that sits. Okay, so I'm hoping that answers both your questions.
Oh, okay, thank you. So you cleared my confusion. So the residual value guarantee actually goes to FV only, the future value.
100%.
Okay. Thank you, sir.
Cool, no worries. Okay, I'm going to take one more question. I do realize that we've been sort of at this for like quite a bit with the reading plus the discussion for an hour. So let me take, okay, I'll take two more questions. And then we'll take, oh, actually, no, rather, let me do this. Okay, let's finish up our discussion. For the two questions, please put them into the chat, right? And then I can deal with them quickly after the break. Because, yeah, I'm just cautious that we also need to finish. Okay. So cool stuff. So let's do that. So put your questions into the chat. Tis, the Lilo and Happiness, and then I will just deal with them during the break, and then let me just continue on this journey. So just to make sure that we finish. Okay. So that is the lease payments. Now, quickly, just to finish up I and N before we take a break. So I is the interest rate. So what are we thinking about when it comes to the interest rate? We're thinking about which rate are we going to use? Another examiner's favorite. Okay, paused for emphasis. An examiner's favorite is testing the interest rate piece for lessee accounting, which is different to lessor accounting. Okay, so for lessee accounting, the rule is, right, you use the rate implied in the lease. That's the rule. You present value your cash flows over the lease term using the rate implied in the lease. The exception, only where the former rate is not available, we use the incremental borrowing rate. Now, that is an easy one for examiners to assess, and one that they like to take advantage of candidate laziness, right? Why? Because because it's very easy for me as an examiner to just give you the incremental borrowing rate, right? And give you enough information to calculate the rate implied in the lease. What do we always see? Candidates will always flock to the incremental borrowing rate to do their PV calculation. What's the challenge? What have you done there? The problem there is you've shot yourself in the foot significantly. Why? Because determining the rate implied in the lease usually is the driver of a considerable amount of marks, right? Easily 3 marks, could even be 4, right? So you lost out on all of those marks. Either one, you're just lazy, or 2, you didn't realize that you need to calculate this interest rate. So I'm going to preempt the question, but Alison, how do I know that I need to calculate? How do I know that I'll need to calculate the rate implied in the lease? The answer is relatively simple, right? If you have all the inputs to calculate the rate implied in the lease. And the input, that is the key input, that should be your key clue that you can calculate this rate, is the fair value of the underlying asset. Because to imply this interest rate, your calculation will look a little bit different. In that now your PV forms part of your inputs, right? Because remember, you always need to have 4 of the inputs to calculate the 1, okay? So you're always going to have the lease payment, so it's the same as up there, with the future value with 1 nuance. You're going to have your lease term, but then the question is, what is the PV? What is the present value that you're going to put into your inputs? And this is the fair value of the asset on lease inception. I think it is. I'll just double check the definition just now. Okay. When you have this number or amount, that is your clue that you can calculate a rate implied in the lease. That is your clue that you must calculate the rate implied in the lease, irrespective of them giving you an incremental borrowing rate. That's your examiner just trying to distract you. Okay. Then you punch all of this stuff into your calculator, and then back to the signage question, right? So this is where now the signage becomes important, because now it depends on what you've picked. So if I've picked all of my cash outflows to be positive, let me just copy these numbers down here. So I've picked all my cash outflows to be positive, then this fair value number needs to be a negative number, right? Because it's the other way around. It's not a cash, not really a cash outflow inflow. It's more like a, I guess it is kind of, but not really. So like the asset coming in, cash going out, asset coming in. Okay, opposite sign. If you don't do the opposite sign thing, then your PV analysis is not going to work. Okay, if you decide to go the other way around, let's say you wanted your cash outflows to be negative, right? Then you just need to make your asset cash flow positive. Okay, so that's the more important thing is consistency. It's not, it matters not whether you go negative or positive for either one. It just matters that you are consistent in what you've decided to do. And then another key thing, back to the guaranteed, unguaranteed. I could get the question. I'm going to preempt the question, but also now, how do we know whether or not to put the guaranteed or unguaranteed residual into my future value? I always forget. I always get this wrong. Answer is in the accounting standard. So if you go to the definition section, so Appendix A, and you look for the definition of the rate implied in the lease, where is it? The rate implied in the lease, which has been highlighted to death, as you can see. It is the rate of interest that it causes the present value of the lease payments. Remember, lease payments is defined, and lease payments includes the guaranteed residual, right? As we just discussed, and the unguaranteed residual. So I need to add the unguaranteed residual in there too, to the fair value plus initial direct costs of the lessor. So another thing that the examiner likes testing is this is the initial direct cost of the lessor only, not the lessees. The lessees gets capitalized on the right of use asset. It's just the lessor only. Examiner loves testing that particular point. Okay, so when calculating the rate implied in the lease, it is both the guaranteed and unguaranteed residual. Okay. And in lease term, sort of very quickly before we go on the break, because I'd really like to just kill that off. Lease term is again another one of the examiner's favorites. It can come through as an exam discussion or like part of a calculation to get that N number, right? So is my N12, is my N5, is my N3? To assess what N it needs to be, you need to apply the definition of a lease. Now, the definition of a lease is sort of on the screen here. It is both the non-cancelable period of a lease, and you add to that any extension options if the lessee is reasonably certain to exercise that option, or termination option if the lessee is reasonably certain not to terminate the contract. Now, what is important here, without going into the details, is business your acumens become quite important here, because you'll see that IFRS 16 gives you a bunch of indicators that help you to assess whether or not a lessee is reasonably certain to exercise these options. Now, notice that the assessment is from the lessee's perspective, not the lessor's perspective, right? So what would the lessee do? However, lease term is the same for both the lessor and the lessee. So even the lessor, when assessing lease term, need to consider what the lessee would do, right? When assessing the lease term. What the lessor would do is irrelevant regarding assessing a lease term. So these are all the things you have to consider in your analysis, in your discussion. So if this comes at you as a discussion question or a critically reviewed question, then all your acumens will come in when you're analyzing all of these points. If it's a calculation, it's likely that they're going to make it a lot more clearer. So there's less judgment to reduce the amount of sort of iterations or sort of options that are available to a response. But you see now with our Piper exam, where there's multiple ways of thinking about things, Psycha is good at giving or allowing different alternative views when it comes to their solutions. So what are all the factors you need to consider, right? So you need to consider whether the option is at market rates. You need to consider whether significant leasehold improvements have been made by the lessor, right? The more sort of improvements made, the more money spent on this asset, the more likely they're going to renew a lease. The more expensive it is to terminate a lease, the more likely the lessee won't. The more, like the example that I used earlier on, if an asset is extremely important to the lessee's operations, the more likely they'll extend the lease. And the more conditionality or the more complex it is to renew the lease or exercise an extension option, the more likely that a lessee won't. Okay, so these are all those acumens that come into play when you're performing this particular analysis. Okay, so running slightly behind time. But I think it's important for us to take a little bit of a break here. So let's take a 15-minute breather. Well, I'll give you 15 and a couple of minutes. And then we'll come back, we'll deal with the right of use asset, then we'll wrap up by talking about lessor accounting very quickly. I'm hoping to be done in max 20 minutes. And then we'll jump right into the Piper question, sort of reading through that, because I really want to dedicate a good chunk of time having that discussion. Okay, so the time on my clock is 9:53. So let's be back at 10:10. Okay, and I'll deal with these questions during the break.